It's good to be back in Jacksonville. As Matt says, we sat around this conference table about 18 months ago and thought, wouldn't it be cool to have a local angel group participate in a venture competition here in Jacksonville to kind of really jumpstart what we believed to be a sleeping giant of an ecosystem. And due to Matt and his staff's efforts, we are really, really excited to be part of Jacksonville and the JVC. So as Matt said, we're an early stage investment firm. We're based in South Carolina. To give you a little bit of the history, so back in 2008, there were a group of investors who wanted to pull together some capital to support companies coming out of the incubators and accelerators in the area. And if you remember what happened in 2008, that was a really, really strange time to be pulling together any capital for any businesses. But the good news was the group that they pulled together to start putting some capital to work. They started making investments, and this was in Greenville, South Carolina. They started a group called the Upstate Carolina Angel Network, UCAN. UCAN started making investments. They really couldn't write a check size big enough to make an impact on a company. And luckily, like I said, they weren't making investments in companies that were already running out of money, so they were able to build a portfolio of pretty strong growing companies. Well, as I mentioned, UCAN couldn't quite write a check size big enough to make an impact, so they were having to syndicate with other groups, angel networks, funds, firms, etc., to try to write a big enough check size to give the company a long enough runway to be successful. So about 2011 was when I exited the company, got involved in UCAN as a member, and quickly realized, what if we took what was being built here in Greenville and replicate that in other markets, at the time just in South Carolina, so we can write bigger checks, attract better deals, have bigger exits, and start recycling some capital. So in 2011, we started the South Carolina Angel Network and did just that. We replicated the model in other groups across South Carolina. Fast forward about 11, 12 years now, as Matt said, we are now by far the largest early stage investors in the Southeast. We're now in 21 different markets. Last year, Jacksonville was our most recent addition. And we've built a great core group of members here in Jacksonville, some of which are in the room, and we're excited to continue to grow that. A couple data points for you. So we are right about at 600 members. We're in 21 markets, 7 funds, and I'll talk about that here in a bit. We have invested in 112 companies at this point. 279 rounds of capital, meaning that not only are we investing in new companies every year, but we're also investing in the portfolio as they continue to grow. We've got 189 capital rounds still in play, represents about 75 companies. We've deployed about $85 million across those 279 transactions. Nothing matters, though. Nothing matters until you get the return. And we've done that enough to have a track record of about 2.5x ROI on realized gains. I want to talk a bit about the recycled capital effect, because many economic developers don't really realize the power of recycled capital. Most of the time, when an ecosystem really wants to get kicked off, they turn to the economic developers. They start putting money to work in the local companies. But what they don't realize is that initial capital that's not what's making the impact. It's the recycled capital, meaning the investors have made money, and they're wanting to deploy that recycled capital into those startups in that community or region. So that's really all we are. We're an avenue for folks to make investments into professionally curated companies across the entire region. Let's talk a little bit about the targets, right? Geography, we only invest in companies in the Southeast. there's a little science behind that. Because we believe that the Southeast valued companies are better in line with how to make money in the asset class, as opposed to what you would see in Silicon Valley, Austin, Boston, New York. Valuations are a little lower. We believe, again, it's in line with the risk that you're taking in this asset class. But it's a pretty broad geography. Think DC to New Orleans to Miami. Stage, you hear a lot of terms as it relates to this asset class: seed, Series A, angel, B round, A round, A plus round. You'll hear all these different terms. A good way to think about when we like to invest is post-revenue, right? So these are companies that have made $1 to one customer. That at least gives us something that we can, a little meat on the bone, if you will, so we can model out what it would look like upon scale. Team, probably the most important element of our diligence is our gut feel on whether or not the team is the right fit to execute on the model. So we spend a lot of time on diligencing the team to make sure they're a good fit for what they're trying to do. Markets, industry agnostic, we'll look at just about everything. Very opportunistic. We tend to lean toward things that aren't necessarily consumer products. Now, we do have a few in the portfolio, but generally speaking, these are tech-enabled, high-growth, high-scale type companies. Structure, we could spend all day on structure, but the takeaway here is that we are equity investors, we're not lenders. So we're looking to effectively buy a portion of the company in return for ownership. The process. This is really where it differentiates us amongst a lot of folks in this asset class. It starts at the top of the funnel. We look at about 20 to 30 deals every month. We narrow that down to a handful that we then bring in through a formal screening meeting. Every month, of that 20 or 30, we have what we call a draft day. So think fantasy football for startups. So we are effectively pitching each other on staff on which companies we want to see move into a formal screening meeting. We'll take 4 to 6 really companies every month. We'll invite them into a screening meeting. At that screening meeting, all 600 members effectively take part in that selection process. We'll ask them to vote. The members will ask them to vote on which company they want to see move into a due diligence process. We will take the top vote getter. We will put together a diligence team comprised of our staff and any of the members who have raised their hand that want to participate in that diligence process. And that's really important because what we're doing is effectively banking on the collective expertise of hundreds of really smart people to diligence the company. So what you get is a really late-stage venture caliber due diligence process that's applied to these early-stage companies. We have an internal scoring rubric that scores the companies on 10 different criteria. Each of the criteria is weighted differently. Our rubric is -2 sucks, +2 is good. So if you think the exit strategy is good, you may have scored a 1.5, for example. If you think it sucks, you might score a -1.5. Everybody's on the diligence team does that, and it will spit out a score that we then present that to the full membership. So the diligence findings, the diligence report, we will present that to the membership, as well as the companies on a road show during that time as well. Once we've socialized the report, if you will, we will pass the hat. That's what the model is. So we will pass the hat to the members. They will opt in or opt out, and then we will aggregate the capital across all the folks that have opted in to make the investment. Once we do that, we generally take a board seat in most of these companies. Our board seat is think of it as the voice of exit, right? So we're there every board meeting talking about how we generate an exit. Hopefully the company does well. and we'll look to exit that company within a 3 to 5 year time frame. Generally speaking, through some kind of strategic acquisition, not necessarily an IPO. So that's the process. There are a couple ways that people get involved in Venture South from an investment standpoint. We'll talk about the active model first. So an individual member will pay $3,000 a year to be a member of Venture South. That doesn't obligate you to do anything. That just gives you access to the curated pipeline, the diligence. We do monthly education with all of our members. And it really just gets you in the game. Think of that as your country club dues, right? So a company comes to the pipeline, you really like it, scores well in diligence. The minimum to invest in that deal is only $5,000, and there's no maximum. Let's just say, for example, you see the company and you want to invest $10,000 in that. Now keep in mind, we do this 8 to 12 times a year of new companies. And we'll also invest in that in the existing portfolio as well as these companies continue to grow. So you'll have an opportunity in any given year of about 25 to 30 transactions that are available. But back to my example. So you see a company you like, scores well in diligence, you indicate you want to invest $10,000. So you would write your check to Venture South Investments. We take a one-time 4% additional capital contribution. This is getting in the weeds a bit, but it's important to understand why we do that. So you would write your check or send your ACH for $10,400. The $10,000 goes into the pot with everybody else that wants to make the investment. The $400 goes into an escrow account to pay for the annual K1s. And it's important to understand because no matter how many investments you make in any given year, you only get one K1, and we manage that process. So the angel investors in the room, they're all nod their head like, wow, okay, that's great. That's a big, big part of what we do. A couple years down the line, the company does well. There's an exit. There's a liquidity event. The distribution would look like this. You would get your initial $10,000 investment back first. You would get your full $400 additional capital contribution back second. So you've been made whole. And then everything else is split 90% to the investor and 10% to Venture South. So that's how we make money, is on the carry, on the profit share. Which also means we are heavily incentivized to go out and find companies that we believe are going to generate liquidity. Again, that's where we're making money on that 20% profit share. So that's the active model. What we realized years ago is that, folks are busy, right? People really like our asset class, but they couldn't come to meetings. They didn't want to really pick and choose their own investments, but they want to participate in the activity. They want to participate in the asset class, and they really liked our process. So we put together a series of funds that gives folks this forced diversification across all of the opportunities that we see in any given year. So let's take the sidecar fund as the first one. So as I mentioned, we'll do 8 to 12 new companies every year, and people wanted to really be put into these companies. So it's more of a fund structure. But think of it more like an index fund. So the sidecar fund only invests if the active members choose to make the investment. So if at least 10 active members put in an aggregate of at least $100,000 on the active side, the fund will kick in a match. So what that's doing is giving you this forced diversification across a 20 to 25 company portfolio that puts the math in your favor, right? As I said earlier, it's really, really important to go into this to make money, right? That's what we need and want investors doing, is making money. Now, venture philanthropy, that's a whole nother asset class, and it's also very important in any given ecosystem. But that's not what we do. We are 100% return focused, and we have to be in order for it to be sustainable. And the good rule of thumb is that, keep in mind, this is a very, very risky asset class. If your money is being managed by any professional money manager, they're likely putting you in a 5% alternative asset class allocation. That's where we play. So this just gives one the ability to actively manage that area of their portfolio. And as I said, this is a risky asset class. So think of it this way. Half the deals you invest in likely going to fail. They're going to go to zero. 25% of the deals you invest in will at least return your capital. The top quartile is where you get your outsized returns. So what that means is you've got to be in a lot of deals because you're going to have a lot of losers, right? And you need some winners to make up for how many losers there are going to be in your portfolio. So the sidecar fund just makes sure it ensures that the portfolio math is in your favor so that you can be in a better position to make money. The opportunity fund is another animal altogether. So as I said, we've got about 75 active companies in the portfolio right now, all of which we know very well, most of which we're on the board of. So we identified an opportunity to cherry pick the companies that we believe are very close to an exit. So this is a way for us to really double down and really lean into companies that has a significantly different risk profile than ones you would see in a given annual investment cycle. So finally, just as I wrap up, the Venture South folks in the room will hear this all the time. It's kind of our mantra. It's not necessarily as strong as a mission statement or things like that, but our mantra is make money, have fun, do good. That's what we literally put on the back of our t-shirts. Make money, have fun, do good. First and foremost, you've got to make money, right? I can't beat that drum enough. It is a whole heck of a lot of fun, right? So you'll see all kinds of different companies in different industry verticals. Some great, some suck, but again, it's a whole lot of fun. If we're really good at the making money piece, the have fun kind of is part and parcel of that. But if we're real good at making money and having fun, the do good comes. So we're not naive to the fact that the nearly $100 million that we have invested have generated a couple $1 billion in follow-on capital, have created a few thousand jobs across the region. So we're not naive to the fact that if we're making money and having fun, the do good piece will follow. I appreciate everything, again, that Matt and his team have done to put this together. We're just super stoked to be a part of it, and I look forward to being here the rest of the time. Thanks a lot.